latest read of inflation spooked investors, pushing stocks deep into the red zone. And now investors are left wondering what comes next. Joining us to talk about this is Jeremy Siegel. He's professor of finance at UPenn's Wharton School of Business. And Jeremy, you've been saying for a while now that you thought we were going to be in for some rockier times. So did anything you saw yesterday surprise you?
Good morning, Becky. Nothing at all. I expected a worse than expected report. And I think that the next month is not going to be good. And remember, we have one more price report before the March meeting. On March 10th, we're going to get the February Consumer Price Index. That's going to be very important. We're all speculating now about whether there's going to be a 50 or a 25. I think March 10th will tell us. And if that number is also above expectations, I think they've got to go at least 50 basis points in March. As you know, I've been saying for over a year, they're way behind the curve. A few minutes ago, you had Como on. He said the same thing. I've been saying that for a long time. It makes no sense to even think about things below 1%, rates below 1% when you're having inflation between 7 and 8. So I think that there's going to be more hawkish surprises. On the other hand, in an inflationary environment, you want to be in real assets like stocks.
Right.
The earnings are coming in. Firms are not having any trouble passing on those higher prices. It's very different than the 70s, that inflation when, OPEC restricted oil and input prices went up and they couldn't pass on. Firms can pass it on. So as a result, I don't expect a bear market. I did say I thought that NASDAQ was going to probably get in the bear market territory. I don't think S&P will, because I think the rate hikes are going to be more aggressive. But they are, yes, behind the curve, very behind the curve.
Shepard Smith here. Thanks for watching CNBC on YouTube.